Every major financial crisis, from the Great Depression of 1929 to the global meltdown of 2008, has followed the same hidden pattern. It's no coincidence that while millions lost everything, a small group of investors made billions. They understood a secret playbook, a recurring cycle that has repeated for nearly a century. The four-phase profit model. Phase 1. Exiting the market. This first phase begins quietly, about 12 to 18 months before the public even senses trouble. It's a period of strategic retreat, executed by those who see the writing on the wall. Think back to 1929. Joseph Kennedy, a legendary investor, famously liquidated his entire stock portfolio just before the crash. His reason? He started getting stock tips from his shoeshine boy. When speculation becomes that widespread, the smart money knows the party is over. Fast forward to the lead-up to 2008, Michael Burry, the eccentric hedge fund manager immortalized in The Big Short, saw the housing bubble for what it was, a ticking time bomb. He bet against the entire market, a move that seemed insane at the time but ultimately netted him and his investors a fortune. At the same time, billionaire John Paulson was orchestrating what's now called the greatest trade ever, shorting the subprime mortgage market and walking away with nearly $20 billion. They all saw the same signs of extreme overvaluation and quietly exited their long positions while everyone else was still buying in. So, where are we today? The parallels are impossible to ignore. Warren Buffett, the Oracle of Omaha, is currently sitting on a record-breaking pile of cash. Jeff Bezos, Mark Zuckerberg, Jamie Dimon of industry have been selling off billions of dollars worth of their own company's stock. This isn't just routine portfolio balancing. The scale of these sales is unprecedented. Why are the ultimate insiders cashing out? The answer might lie in a metric called the Buffett indicator. It is a simple ratio that compares the total value of the stock market to the country's GDP. Historically, a ratio around 100% is considered fairly valued. Right now, it's soaring at levels that scream extreme overvaluation, signaling that stocks are priced for a perfection that simply doesn't exist. For those who understand this cycle, cash isn't just idle money. Cash is a position. It's the strategic choice to step away from the table before it collapses, preserving capital for the opportunities that always follow the chaos. Phase 2. The crash. This is the phase everyone remembers: the panic, the free fall, the headlines of doom. But for the financial elite, this isn't a disaster. It's a calculated event they've been preparing for. When the crash finally hits, it's not a random act of nature. It's often triggered by a specific catalyst, an event that pops the speculative bubble. In 1929, it was the London Stock Exchange crash that sparked the initial wave of selling in New York. In 2008, it was the bankruptcy of Lehman Brothers, a move that sent shockwaves through the global financial system. The key here is that the insiders who exited in Phase 1 don't just watch from the sidelines. They actively participate in the downturn. This is where they deploy the short sell. Short selling is essentially betting that a stock's price will go down. Investors like Michael Burry and John Paulson didn't just sell their assets. They took massive positions that would pay off handsomely as the market cratered. They were profiting from the collapse they saw coming. And what about the average person during this phase? They're caught completely off guard. Their retirement accounts evaporate, their home values plummet, and their jobs disappear. This is the brutal transfer of wealth, where the unprepared majority is wiped out, while the prepared minority profits from the decline. The media fans the flames of panic, urging everyone to sell at the bottom, locking in their losses. It's a symphony of fear, and it plays out the same way every time. The insiders who got out early and then shorted the market are now watching their bets pay off, accumulating even more capital while the world around them burns. Phase 3. The bottom and the bailout. After the storm of the crash, an eerie calm settles over the markets. This is Phase 3. The point of maximum pessimism. The public is terrified. No one wants to touch stocks. The news is filled with stories of economic ruin and predictions of a new Great Depression. This, right here, is the moment the elite have been waiting for. This is the bottom. But how do they know it's the bottom? They don't just guess. They watch for a very specific signal. The government bailout. After every major crash, the government and central banks inevitably step in to save the economy. In the 1930s, it was the New Deal. In 2008, it was the TARP program, the Troubled Asset Relief Program, which injected hundreds of billions of dollars into the banks, most recently during the 2020 crash. Central banks unleashed trillions in stimulus. This intervention does two things. First, it creates a safety net under the market, preventing a complete systemic collapse. Second, it floods the system with cheap money. For the investors who preserved their cash in Phase 1 and made a fortune in Phase 2, this is the starting gun. While the public is still paralyzed by fear, these investors begin to buy, not just any assets, but the highest quality assets, blue chip stocks, prime real estate, entire companies, all available at fire sale prices. They are buying from the very people who are forced to sell. Panicked retail investors, hedge funds facing margin calls, and families who need to liquidate assets just to survive. This is the greatest wealth transfer in the cycle. The elite used the capital they protected and generated during the crash to buy up the crown jewels of the economy for pennies on the dollar. They know that the massive government stimulus will eventually reinflate asset prices. They aren't just buying stocks. They are buying future wealth at a historic discount, funded by the very systems that are supposed to be helping everyone. Phase 4. The recovery and the next bubble. This is the final phase of the cycle, and it's where the truly astronomical fortunes are cemented. It begins as the fear from the crash starts to fade. The government stimulus and low interest rates start working their magic. Money is cheap, and it has to go somewhere. Slowly at first, and then all at once, it flows back into the stock market and other assets. The investors who bought at the bottom in Phase 3 now ride this massive wave of recovery. The high-quality assets they acquired for pennies on the dollar begin to soar in value. A stock they bought for $10 goes to $50, then $100, then $200. The public, who sold in a panic at the bottom, eventually sees the market rising and gets FOMO, the fear of missing out. They start buying back in, but now at much higher prices, fueling the rally further. This is how a new bubble is born. The central banks, afraid of stalling the fragile recovery, keep interest rates low for years. The media narrative shifts from doom and gloom to irrational exuberance. No financial innovations appear, and stories of ordinary people getting rich overnight become common. Sound familiar? It's the same environment that existed right before the last crash. The elite investors, who have now multiplied their wealth many times over, watch as valuations become stretched once again. They see the Buffett indicator climbing. They see their shoeshine boys giving them stock tips. And what do? They quietly begin Phase 1 all over again. They start selling their assets, converting their massive gains into cash, and preparing for the next inevitable downturn. The cycle is complete. It's a brilliant, brutal, and endlessly repeating model for concentrating wealth. For those who don't understand it, it's a lifetime of booms and busts. But for the few who do, it's a predictable road to unimaginable riches. The only question is, where in the cycle are we right now? After sensing the shift, the smart money exits the market. But they don't just sit on cash. They move to Phase 2, buying volatility insurance. This is the golden ticket. A strategic move made 6 to 12 months before the storm hits. Think of it as a preemptive strike, positioning themselves not just to survive the chaos, but to profit from it. History gives us a clear playbook. In the summer of 1929, just before the Great Crash, Joseph Kennedy, patriarch of the famous family, didn't just sell his stocks. He famously went short, betting against the very market that had made him rich. He saw the shoeshine boys giving stock tips and knew the end was near. Fast forward to the 2008 global financial crisis. Characters like Michael Burry and John Paulson became legends. They didn't short the entire market blindly. They identified the poison at the heart of the system. Subprime mortgage bond. Their weapon of choice was the credit default swap, or CDs. Essentially, they bought insurance policies that would pay out massively when these toxic bonds inevitably defaulted. It was a contrarian bet of epic proportions, a wager against the collective delusion of the entire financial world. They were ridiculed. Their investors threatened to pull out, but they held firm, confident in their analysis that the foundation was rotten. More recently, in the lead-up to the 2020 crash, hedge fund titan Bill Ackman executed a similar mess. He saw the pandemic coming and understood its potential to cripple the global economy. In late February 2020, he spent $27 million on credit default swaps against corporate bonds. He was buying insurance on the health of corporate America. Just 1 month later, as the market cratered, he cashed out that insurance for a staggering $2.6 billion. It was one of the greatest trades of all time, a perfect example of turning fear into a fortune. It's not about predicting the exact day of the collapse, but about positioning for the inevitable explosion in volatility. So, are we seeing these same patterns play out now, as we look toward a potential downturn? The signs are flashing. Look at the put-call ratio, a key sentiment indicator. A put option is a bet that a stock will fall, while a call option is a bet that it will rise. When this ratio spikes, it means far more investors are buying puts, preparing for a decline. We're seeing significant spikes in this ratio, indicating a deep-seated institutional fear. At the same time, institutional players are buying massive volumes of VIX calls. The VIX, often called the Fear Index, measures expected market volatility. Buying a call option on the VIX is a direct bet that fear and volatility are about to skyrocket. It's the modern equivalent of what Burry and Paulson did, a sophisticated way to ensure a portfolio against a market shock. And it's not just the stock market. In the credit markets, the spreads on commercial mortgage credit default swaps are soaring. This means the cost to insure against defaults on commercial real estate loans is getting incredibly expensive. A clear signal that the insiders who deal in this debt see serious trouble ahead. These aren't just abstract numbers. They are the footprints of giants moving into position, preparing for the earthquake they feel is coming. But buying insurance is only the setup. Then comes phase 3, where the real profits are made. This is the shorting phase, the final, decisive move made 3 to 6 months before the collapse becomes public knowledge. It's where fortunes are truly forged. It's about moving from a defensive, insured position to an aggressive, offensive one. It's no longer about just protecting capital. It's about capitalizing on the downfall of the weak. The smart money has already identified the most vulnerable sectors, the companies with fatal flaws that will be exposed when the tide goes out. In 2008, the targets were clear. Michael Burry and John Paulson, having already bought their insurance, doubled down by directly shorting the stocks of the financial institutions most exposed to the subprime meltdown. Giants like Lehman Brothers and Bear Stearns, once considered pillars of Wall Street, became their primary targets. They saw that these firms were leveraged to the hilt with toxic assets, their balance sheets a house of cards waiting for a gust of wind. When the defaults began to cascade, these firms didn't just stumble, they vaporized. And every dollar their stock value lost was a dollar gained for the shorters. Today, the echoes are undeniable. Where are hedge funds building their massive short positions now? The crosshairs are locked on 2 specific sectors: commercial real estate and regional banks. The parallels to 2008 are chilling. Commercial real estate is facing a perfect storm. The rise of remote work has left office buildings sitting empty, pushing vacancy rates to historic highs. Meanwhile, years of near-zero interest rates are over. Property owners who need to refinance their debt are now facing surging borrowing costs that their rental incomes simply can't cover. This is a slow-motion train wreck, and a tidal wave of defaults is considered not just a risk, but an inevitability. The regional banking sector is inextricably linked to this crisis. These are the primary lenders for many of these troubled commercial real estate projects. Their loan books are saturated with assets whose values are plummeting. We've already had a tremor with the failures of institutions like Silicon Valley Bank and Signature Bank. Those weren't isolated incidents. They were canaries in the coal mine, warning of a systemic weakness. As commercial real estate loans begin to sour in earnest, the pressure on these banks' balance sheets will become unbearable. Hedge funds are dissecting these balance sheets, identifying the banks with the highest exposure and the weakest capital buffers, and building their short positions, ready to profit from the next wave of failures. They are patiently waiting for the music to stop. But the final act of this financial drama is the most spectacular. This is phase 4. Going all in at the peak of panic. This happens right at the moment of collapse, when the news finally hits the mainstream, and the public is consumed by fear, while everyone else is panic selling. The smart money makes its boldest move. This isn't just about collecting on their shorts or insurance. It's about buying up the world's best assets at fire sale prices. It's the ultimate transfer of wealth. Think back to March 2009. The financial world was in ruins. The S&P 500 had bottomed out. Public sentiment was at an all-time low. It felt like the end of capitalism. But for investors like Warren Buffett, it was the beginning. His famous advice, "Be fearful when others are greedy, and greedy when others are fearful," was put into action. He invested billions into solid, blue-chip companies like Goldman Sachs and General Electric, companies that were beaten down but fundamentally sound. He wasn't catching a falling knife. He was picking up diamonds from the ruble, knowing that the fear was temporary, but the value was permanent. Similarly, in March 2020, as the world locked down and markets plunged, those who had prepared went on a shopping spree. While retail investors were liquidating their portfolios in a panic, institutional funds and savvy individuals were buying hand over fist. They bought technology, healthcare, and consumer staples, the essential pillars of the modern economy, at discounts of 30, 40, or even 50%. They understood that a global pandemic, however terrifying, wouldn't erase human innovation or the need for essential goods and services. The subsequent market recovery was one of the fastest in history, delivering astronomical returns for those who had the courage and the capital to buy when there was blood in the streets. So what does this mean for the near future? When the next crisis inevitably hits, whether it's triggered by commercial real estate, geopolitical conflict, or something completely unforeseen, the pattern will repeat. There will be a moment of maximum panic. The headlines will scream crises. Your friends and family will be selling everything. That is the signal. The assets that will be on sale are the bedrock of our future economy. Think about sectors like artificial intelligence, biotechnology, renewable energy, and advanced logistics. These are not fads. They are fundamental shifts in how the world operates. The leaders in these fields, companies with strong balance sheets, innovative technology, and durable business models, will see their stock prices plummet along with everything else, but their intrinsic value will remain. This is the opportunity of a lifetime. The strategy is to have your watch list ready, your capital prepared, and your emotions in check. You need to know exactly what you want to buy before the sale begins. So, how do you prepare? First, reduce your exposure to overvalued and speculative assets. Build a significant cash position. This isn't about timing the market perfectly. It's about having the ammunition ready for when the opportunity presents itself. Second, do your homework now. Identify the high-quality, fundamentally sound companies and sectors you believe in for the long term. These are the assets you will want to buy when they go on sale. Finally, and most importantly, cultivate psychological resilience. The hardest part of the strategy is acting decisively when your every instinct is telling you to run and hide. The financial media will be a chorus of doom, but your research and your plan will be your guide. Crises are not just moments of danger. They are moments of immense opportunity. The greatest transfers of wealth in history don't happen during the calm. They happen during the storm. By understanding these phases, you can learn to see the storm not as a threat, but as the chance to secure your financial future. When the music stops, when the headlines are screaming doom, and when everyone else is running for the exits, the truly great investors make their move. This isn't just about weathering the storm. It's about sailing into it with a clear map and a treasure chest waiting on the other side. This is the final, most counterintuitive stage of the cycle. And when fear finally hits its absolute peak, they do the unthinkable. They begin phase 4, buy in when panic peaks. Think back to the ashes of the 1929 stock market crash. The Great Depression was setting in, and fortunes were wiped out overnight. But while most saw only ruin, Joseph P. Kennedy, patriarch of the Kennedy dynasty, saw a once-in-a-generation opportunity. He began buying stocks and real estate at prices that were, just months earlier, unimaginable. He wasn't just buying assets. He was buying the future of America at a steep discount. Fast forward to 2008. The global financial system was on the brink of collapse. Lehman Brothers had fallen, and fear was palpable on Wall Street. Who stepped in? Warren Buffett. He famously said it's wise to be fearful when others are greedy, and greedy when others are fearful. And he lived by those words, making a $5 billion investment in Goldman Sachs, and another $5 billion in Bank of America. These weren't just financial lifelines. They were brilliant investments that netted Berkshire Hathaway billions in profits. Buffett wasn't betting on a bank. He was betting against the hysteria. And then, 2020. A global pandemic brought the world to a standstill. Markets plunged in a matter of weeks. Bill Ackman, after making a fortune betting against the market with credit default swaps, did a complete 180. As his bearish bets paid off handsomely, he took those winnings and plowed them right back into the stock market, buying up shares of great companies like Hilton and Starbucks. At severely depressed prices, he understood that the panic, while real, was temporary. The underlying value of these businesses was not. So, what does this mean for the near future? Where is the next blood in the streets opportunity? All signs point to a potential Phase 4 unfolding around 2025 to 2026. Right now, there are hundreds of billions, perhaps even trillions, of dollars in what investors call dry powder. This is cash, sitting on the sidelines, waiting for the perfect moment to strike. Warren Buffett's Berkshire Hathaway is holding a record cash hoard of over $180 billion. Private equity firms, the modern-day corporate raiders, have raised unprecedented amounts of capital. They are all patiently waiting. Waiting for what? Exactly. They're watching the commercial real estate market, where office buildings are struggling with high vacancy rates. They're eyeing corporate debt, as rising interest rates put pressure on over-leveraged companies, and they're monitoring the housing market for potential foreclosures. They aren't hoping for a crisis, but they are prepared for one. Their goal is to swoop in and acquire these distressed assets, not at a small discount, but at 30, 40, or even 50% off their peak values. This is the ultimate poker game, where the players with the most cash and the strongest nerve win the biggest pots. It's a strategy built on a simple but powerful premise. Fear creates fortune. While the average person sees a market crash as a catastrophe, the seasoned investor sees it as a sale. This four-phase cycle, from the euphoric highs of a bull market to the desperate lows of a crash, and the strategic accumulation that follows, is not a new phenomenon. It's a pattern that has repeated itself for centuries. It's driven by the most powerful forces in any market: greed and fear. Understanding this cycle doesn't mean you can predict the exact top or bottom. No one can. But it gives you a framework. It allows you to see the bigger picture, to recognize the phase we're in, and to prepare for what might come next. It helps you to quiet the noise of the daily news cycle and focus on the long-term rhythm of the market. The key takeaway isn't to be reckless. It's to be prepared. It's about building your own dry powder during the good times, so you have the resources to act when the bad times inevitably arrive. It's about having the conviction to buy when your instincts are screaming to sell. The greatest opportunities are rarely found in the calm seas of a bull market. They are born in the chaotic storms of a crisis. By studying the past, by understanding the psychology of the market, and by learning from the masters, you can position yourself not just to survive the next downturn, but to thrive in its aftermath. Because in the world of investing, the darkest hour is often just before the dawn. Thank you for watching. If you found this analysis valuable, please like this video and subscribe to our channel for more deep dives into the world of finance and investing. We'll see you in the next one.